Hello students, once again welcome back to another DTLP class. In this class we'll pick up from where we left off. So it will be a continuation of the previous topic, that is income from house property, where we were taught how to find out the annual value in the case of let out property. In the previous video, you were taught how annual value can be calculated under 4 conditions. In this video, we'll be starting from condition number 5. We will deal with problems relating to the method on how to find out ARV under condition number 5. Condition number 5 states that if house property is let out for a part of the year because it was either purchased or constructed during the previous year, all rental values are taken only for that period for which the house property is in existence or owned by the assessee during the previous year. In other words, all rental values will be taken in corresponding with the number of months it was in existence or owned. For example, in the previous year 2018-19, the construction of the house was completed on the 1st of June 2018. Therefore, it came into existence on this date. From 1st of June 2018 to the 31st of March 2019, the house was in existence for 10 months in the previous year 2018-19. In this case, all rental values such as MRV, FRV, standard rent, actual rent will be taken for 10 months period only instead of 1 year. This can be understood further by solving the following problem. This is your problem number 1, which we will be solving. In this problem, we have to compute the ARV for the previous year 2018-19. MRV given is 60,000, FRV 66,000, standard rent 63,000, actual rent is 6,000 per month. Date of completion of the house property is 31st of May 2018. Date of letting 1st of August 2018. These are your working notes. It is very important to keep these working notes because half of the problems can be solved in the working notes itself. Given in the question, the property was in existence from the 31st of May 2018. So, from 31st May to 1st April 2019, the property was in existence for a period of 10 months in the previous year. Also, it was let out from the 1st of August 2018. Okay, so from the 1st of August to 1st April 2019, it comes to a period of 8 months, which shows that there is a vacancy of 2 months. Since the house was in existence for 10 months, hence all rental values will be taken for 10 months period only. So this is your solution. First, we have to find out your ERV by firstly comparing your MRV with FRV. We can see here that MRV is not taken for the full value of 60,000. Instead, the value of 10 months period is taken from the full value. In order to find out the value for 10 months period, we multiply the full value of 60,000 into 10 divided by 12, which will give you 50,000. Similarly, for your FRV, we take 66,000 into 10 divided by 12. We will get your final FRV, that is 55,000. Whichever is higher is taken. So 55,000 is taken. Standard rent also is multiplied by 10 divided by 12, which will give you 52,500. Here, whichever is lower is your ERV. Here, 52,500 is lower, so that will be your ERV. Actual rent for 10 months. 60,000. You can see actual rent is also taken for 10 months and not for 12 months. Whichever is higher will be your ARV. So 60,000 is higher than 52,500. This will be your ARV. From your question, we have vacancy. So we deduct the loss due to vacancy. Vacancy is for 2 months. Loss is 12,000. So after deducting, the final ARV is rupees 48,000. I hope that's clear. Another problem. Okay, we'll move on to another problem in order to understand better. In this problem, we also have to compute the ARV for the previous year 2018 and 19. Okay, MRV is rupees 84,000 per annum, FRV rupees 90,000 per annum, standard rent 87,000 per annum, unrealized rent rupees 4,000 per annum, real rent or actual rent is rupees 8,000 per month. Date of completion of the building is on 31st of July 2018. Date of letting 1st of October. So in this problem we can see that there we have to deal with condition number 5 and also unrealized rent and also vacancy. Your working notes. Here the property was in existence from 31st July 2018. Okay, so from the 31st July 2018 to the 1st of April 2019, it comes to 8 months. It was let out from the 1st of October 2018. So from 1st October to 1st April 2019, it comes to 6 months. Okay, we can also see that there is a vacancy for 2 months. The house was in existence for 8 months, hence all rental values will be taken for 8-month period. Okay, so we find out the actual rent for 8 months, which is equal to 8,000 into 8. This is 8,000 into 8 is some mistake here, which you will get rupees 64,000. So this is your solution. MRV is taken for a value of 8 months. That is 80,000 into 8 by 12. You'll get 56,000. FRV is also taken for a value of 8 months. 90,000 into 8 by 12, which you will get 60,000. Whichever is higher will be taken. So 60,000 is taken since it's higher. Standard rent is also taken for a period of 8 months. So 87,000 into 8 by 12, 52,500. Here whichever is lower is your ERV. Since 52,500 is lower, so this is your ERV. Actual rent for 8 months is 64,000. Okay, since we have unrealized rent, we have to deduct the unrealized rent from your actual rent. After deducting, the actual rent comes to 60,000. This actual rent will be compared with the ERV. Whichever is higher is your ARV. In this case, actual rent is higher, so 60,000 will be your ARV. We also have vacancy. Therefore, we have to deduct the loss due to vacancy. Vacancy is for 2 months, which comes to 16,000. So after deducting the loss due to vacancy, the final ARV is rupees 44,000. Treatment of municipal taxes. So if there are municipal taxes that are being paid in the previous year, how do we treat them? For the purpose of finding out taxable income, municipal taxes are deducted to arrive at the net annual value. While deducting municipal taxes, the following points are to be kept in mind. The first point, the taxes are deducted from the gross annual value. Second point, only paid municipal taxes are allowed for deductions. The third point, outstanding taxes are not allowed as deductions. Fourth point, in order to get deduction, the municipal taxes must be borne by the owner and not the tenant, which means the owner must be the one to pay the taxes and not the tenant. Fifth point, deductions can be in the form of house tax, water tax, conservancy tax, education cess, sanitation cess, sewerage tax, or any other tax levied by the authority in respect of the house. These taxes must be levied by the state government. Okay, other points to be noted. We should also remember that the annual value before deducting tax is known as the gross annual value. Okay, and the annual value after deducting tax will be your net annual value. Regarding taxes, I've given another problem to show you how do we solve it. So in this problem, we have to calculate the net annual value for the period ending 31st of March 2019. That means previous year 2018-19. Date of completion 1st of June 2018. The rent received or the actual rent is rupees 4,000 per annum. Municipal rental value rupees 36,000 per annum. Municipal taxes 10% of MRV. He paid rupees 50% of the taxes during the year 2018-19. In this problem, we have to deal with condition number 5, that is the house was in existence only for a part of the year and not for the whole year, and also deduction of municipal taxes. These are your working notes. Date of completion is on the 1st of June 2018. Therefore, the house was in existence for 10 months. MRV for 10 months will be rupees 30,000. And also municipal taxes will be equal to 10% of MRV. So 10% of 30,000 will come to 3,000. We should also remember that only outstanding taxes are not deducted from your gross annual value. Therefore, we have to deduct only the municipal taxes that are actually paid by the owner, which is 50% of 3,000 equal to rupees 1,500. This is your solution. 2 amount column, 1 particular column. Here MRV for 10 months we have calculated is 30,000. Actual rent received for 10 months, since there is no other information, we have only MRV. So we directly compare MRV with actual rent, in which we will get your actual rental value. Whichever is higher will be your actual rental value, which is 40,000. Actual rent is 40,000, and we deduct the municipal taxes of 1,500. So your net annual value will be 38,500. Problem number 4. This problem you will have to try and solve by yourself. That's all for today. Thank you.